If you owe the IRS over $100,000, you've probably heard about something called an offer in compromise, which is basically settling your tax debt for less than the amount you owe. But here's the reality. Most people with large tax debts either don't qualify, they get rejected because they completed the information correctly or made an offer too low, or they settle for far more than they expected. I'm Bob Jablonski, a certified tax resolution specialist, and my practice primarily works with helping taxpayers with large IRS tax debts successfully navigate the system. In this video, I'm going to walk through with you how the offer in compromise actually works for large tax debts, what the IRS is really looking at, why many offers for taxpayers with large tax debts fail, and when this strategy actually might make sense for you. So first, let's talk a little more about what an offer in compromise actually is. An offer in compromise, or an OIC, is a program through the IRS that allows you to settle your tax debt for less than the full amount you owe. Most people don't understand the qualification and calculation of the settlement are based on specific formulas. They're not something where you say, I'll pay the tax, but I won't pay the penalties and interest, or I'll offer the IRS half the amount. The formula or calculation is reasonable collection potential, or also known as RCP. And while there are gray areas to work within when requesting an OIC, there is a formula that needs to be followed. That's the way of the IRS asking, what is the most I can reasonably expect to get from you before the statute of limitation expires or runs out? If your offer equals or exceeds that number, it has a chance. If it doesn't, it will likely get rejected. So why are large tax debt cases different? Well, when your balance is over $50,000, and even more so when it's over $100,000, everything's going to change. You're more likely to have already been assigned to a revenue officer, and you're more likely to be scrutinized much more closely. And the IRS is going to look at your income, your expenses, not just your actual lifestyle expenses, but based on IRS standards, which really is complicated for most people to understand. They're also going to be looking at your assets and your future earning potential. All of those things are things that they analyze to determine if you qualify for an offer, and if so, what it looks like. So this is not a simple application. It's going to be a financial deep dive whenever you're completing that request. So how is the IRS going to calculate your offer? They're typically going to look at two main components. They're going to look at your net equity and assets, and they're also going to look at your future income. So first of all, let's talk about net equity and assets. That means they're going to look at your bank accounts, your checking, your savings accounts. They're going to look at your investment accounts. They're going to look at retirement accounts. They're going to look at real estate, including your home residence, and vehicles and other assets. And based on that, they have a calculation, they have a formula which determines how much of your equity in those assets, if anything, is available to pay the IRS down, and it would be calculated as part of your offer. So part one is they get that net equity and assets. Part two is they take a look at your future income. And what they typically are doing there is looking at the next 12 months or next 24 months, and they're looking at your disposable income, once again using your income calculation less your allowable expenses to come up with your monthly disposable income, and then that's multiplied by 12 or 24 months. So if it's determined you have $2,000 a month available, so it would either be 24,000 or 48,000 towards that offer. They're going to take part one as net equity and assets, and part two of that future income, and together that's what's going to be your minimum offer. So why do most offers for $100,000 plus cases fail? Uh, Most people think, and I mentioned this earlier, they think, well, I owe $150,000. Maybe the IRS will take $10,000. Something's better than nothing. Or you'll settle for half, or you'll pay them the taxes, but not the penalties and interest. But like we talked about, this is almost never going to work unless it somehow magically is, comes out to pretty much exactly what RCP is, or it comes out to more than what RCP is. Most of these offers are going to fail because the income is too high or the expenses are well over IRS standards, and basically that disposable income is very high. The other thing is there's a lot of people who have earned a substantial amount of income who have a lot of equity, even if they don't have cash liquid assets. They have a big retirement plan or they have a home with a lot of equity into it. In those cases, sometimes the IRS believes they can get more through other collection options. So they believe they might be able to believe they can collect more through installment agreements, wage garnishments, or maybe they can liquidate some of those assets, or they're going to require that you liquidate some of those assets you have in order to make your offer. So when may an offer in compromise make sense for a taxpayer with a large IRS debt? An offer in compromise will usually work best when the taxpayer has limited disposable income. Maybe they made a lot of money in the past, but that's not the case anymore. And their expenses, as far as their allowable expenses, their income and expenses, they match up pretty closely. So there's not a big gap there for disposable income. There's minimal equity in assets. That might be a case too. Even though they earned a lot of money, they don't have a lot of assets for the IRS to tell them to liquidate. Maybe the IRS cannot realistically, they know they can't realistically collect the full amount, and this is the best offer they believe they can get. Or in some cases, remember the IRS only has 10 years to collect the tax debt. So the closer you are to that 10-year statute of limitations, the less likely the IRS is going to be able to get a payment plan in place that will give them a substantial amount of money. So these things are especially common for self-employed individuals, as I mentioned, with declining income, businesses that are no longer earning the income they have in past, taxpayers with large balances but unstable cash flow, or situations where financial hardship is well documented. So it's important to remember that there are alternatives to an OIC. Not everyone qualifies, as we mentioned, for an OIC. As a matter of fact, a lot of people with large tax debts that don't qualify. There's things like currently not collectible. Let's say you earned a lot of money in the past, you're likely to earn a lot of money in the future, but perhaps you're currently unemployed. Well, you may qualify as currently not collectible status, or you may qualify for a partial pay installment agreement. And sometimes standard installment agreements are just going to be the best thing for you. In many cases, these options are a lot easier to qualify for. They're less intrusive and they're more strategic depending on your situation than an offer would be in your case. So to wrap this up, if you owe the IRS over $100,000, the key is not just finding a solution, it's finding the right solution for you based on your financial situation. Hey, believe me, an offer in compromise can be powerful, but only if it's structured correctly. If you'd like help reviewing your situation, I've included a link both below in the comments as well as in the description to this video, and reach out to us and we'll get something set up. And if you found this video helpful, make sure to subscribe to our channel because I break down real IRS problems strategically for taxpayers dealing with large tax debts such as you.